Hello. With interest rates getting higher, it's hard to find good stocks to invest in, especially stocks that have very little debt. I've got 5 really good dividend growth stocks for you to look at today with low debt and offer the potential to make good long-term rates of return. Hello, everybody. This is Chuck Carnevale, co-founder of FastGrass, the Fundamentals Analyzer software tool, a.k.a. Mr. Valuation. Today, I'm going to present 5 A-rated high-quality dividend growth stocks with very, very little debt. Many of you, I know, since I've been, getting comments in the comment threads and I'm talking to people who are concerned about debt. Well, all 5 of these stocks are A-rated or better. They have very little debt and they have good growth potential. And most important of all, from the standpoint of Mr. Valuation, you can buy them at very attractive values. So let's quickly go through these 5 research candidates that can make you some money in this high interest rate environment. As usual, I'm going to do this in alphabetical order because it makes sense, but let's look at these companies. This is going to be a high-level presentation. I'm going to be covering 5 companies here, and I think you're going to find them very attractive. So let's actually start by going into the portfolio itself, and I'll do this by order of alphabet. These are all A-rated or better. The lowest rating is Cigna with an A- rating. All these companies have very low debt to capital, relatively speaking. The highest is Caterpillar at 41%. The lowest would be Chubb at 21%. So the debt is very manageable for all these companies. The companies all do pay a dividend, and it's pretty much, market neutral or a little bit higher. But all of these also offer double-digit future rates of return for the next 2 or 3 years. And they can all be bought at attractive valuations, as you'll see when we get into the stocks individually. I'm going to do a high-level presentation here. So let's start with Aflac. Everyone knows Aflac the duck. I want to point out a couple of very interesting things about Aflac. Aflac is a financial life and health insurance. It has 25.82% long-term debt to capital. It's A- rated. It has an earnings yield of 7.82%, which is higher than my 6.67% minimum threshold. It offers a dividend of 2.2%, and you can buy it at a blended PE of 12.79. Now, I do want to point out the normal PE ratio for the stock historically since the Great Recession has been about 12.49. But we're going to look at that a little bit closer because prior to the recession of 08 and 09, when financial stocks especially got hit, we saw this stock trading routinely at PEs of 18 to 20 or higher. The orange line on this graph is a PE of 15. The blue line is a PE of 12.49. Okay, so let's shorten this time frame till we get past the recession and look at where it's been trading at more recently. It's been trading at around a 10 multiple. So it's a little bit above that right now. But I still think this stock is attractive here because it has low debt and it's A-rated, so it might command a little better valuation than it's historically been grabbing. So if we look at the last 5 years only, it's traded at about 11.35 blended PE. If I look historically, it's been as high as 12.49. All in all, this stock does offer at those, valuations, a rate of return of about 5.5 or 6%. But the point is here, it's quality and safety is what I want to emphasize with Aflac, with low debt. Caterpillar, in contrast, is a semi-cyclical stock. The market has routinely traded it at a slight premium. But again, when I say things like that, I want you to understand that I'm using this as a valuation reference. Okay, this is a 17.39 PE ratio, the blue line. Is that anywhere you touch the stock, touch the blue line, it would be trading at 17.39. Okay, you can see a lot of times it's below that, a lot of times it's above that. But I want you to notice, even though this stock has been cyclical, the dividend record has been excellent all the way through, and they've grown their dividend. It's A-rated, has a 41% debt to capital, which is very manageable and low. Dividend yield of 1.84%, an earnings yield of 6.43%, and a blended PE of 15.56. Although I'd like to see this a little bit cheaper, if I look at it from a forecasting point of view with almost 13.5% growth expectation, and if I run my numbers out to the logical conclusion by simply pointing at this last triangle here, I could make 13.38% a year, assuming this stock traded at a 15 multiple. And you can see historically, the stock has traded at a 15 multiple quite consistently over time. So I really like Caterpillar at these levels right now, especially in this high interest rate environment. Chubb, which is a property and casualty insurer. Let's shorten the time frame a little bit to get a little better picture. The market likes to put a lower multiple than the 15 PE that I would normally say the stock is worth, although it does trade at a 15 PE, or has traded at a 15 PE quite often. Today you can buy at 11.78 times blended PE earnings. It has an earnings yield of 8.49%, dividend yield of 1.67. It's A-rated and only has 21% debt to capital. But I think most importantly, the company's earnings are expected to really ratchet up and grow a lot faster in the next 3 to 5 years. So we're looking at 12.9% growth. Again, you can buy the stock at a discount. If we use the normal multiple here, more recently it's been a little higher, but I like to go to the long-term multiple, which has been around 12. The stock could still generate almost a 17% annualized rate of return out to December 31st, 2025. A-rated, only has 21% debt. The next stock on the list would be Cigna Corp. Cigna has recently just started paying a dividend, but it does offer a 1.73% dividend yield. This has been primarily a growth stock. As you can see, historically, the company has grown at double-digit rates, and the market has followed that. It does trade at a lower PE ratio than normal, given the fact that it is in the healthcare sector right now. But if I look at it from a normal multiple of 12.72 over the last 5 years, it generated about an 18% rate of return. If I put in the longer term, more conservative 11.84, it still offers the potential to generate 14.55%. So I'm kind of giving you a moderate or a conservative case and, of course, a more aggressive case. Now, if it went to 15 times earnings, which I think it deserves, it could be as high as 26%. So that's something to consider. We're looking at this stock since we've come out of the Great Recession. It's been trading at a low valuation relative to its historical norms, but there are many times when it reaches that 15 PE. Cummins is the next one on the list here. Looking at Cummins, it's a double-digit grower. It's similar to Caterpillar. It's somewhat cyclical. It trades around 14 to 15 times earnings normally. The stock currently trades at a blended PE of 12.5, so it's at a discount, has a very strong earnings yield of 8% and a very strong dividend yield of 2.88%. It's A-plus rated with only 29.5% long-term debt to capital. I really like this stock here. I think as a long-term investor, you can do very well. I do believe a 15 PE would give you a 19% annualized rate of return. A 14.71 PE would give you about 18%. So we're looking at 18 to 20% potential rates of return from an extremely high-quality company with very, very low debt here. So these are our 5 dividend growth stocks that I feel that all of you might want to take a look at if you're looking for a high-quality, A-rated or better stocks that have moderate levels of debt in today's high interest rate environment that can offer to give you double-digit rates of return going forward. You might want to take a look at these 5: Aflac, Caterpillar, Chubb, Cigna, and Cummins. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Hope you enjoyed this high-level video where I looked at 5 stocks with low levels of debt. I know a lot of you are concerned about debt. These would be 5 companies you can look at to put in your dividend growth stock portfolios. They offer a good long-term total rate of return, a decent level of dividend, and debt is not a problem for these companies, at least in my opinion. Thanks for watching. If you liked the video, give me a like, subscribe to the channel, ring the bell and all that good stuff. And for goodness sakes, take a look at FastGraphs. If I couldn't even imagine investing in stocks without it. Thanks for watching.